Hey everyone, how's it going? It's Dan Russo, the Chief Market Strategist at Chaikin Analytics. Wanted to bring some updated thoughts as the first half of the year comes to a close, as we move into the second half of the year. Obviously, the first half was extremely volatile in both directions, right? COVID-19 crash and then the sharp rebound on the heels of a lot of fiscal and monetary stimulus brought about to help support the economy going forward. Obviously, this is a theme that continues to play out, but rather than get caught up in the narrative, what we like to do is just observe what is going on from a trend and momentum perspective and try to be positioned accordingly. So as the first half of the year comes to a close, in the equity markets, growth remains the dominant theme as far as I'm concerned. If we look at the best performing equity ETFs, they have a growth theme, whether it's the Qs, the Invesco QQQ Trust, or the Russell 3000 growth ETF or Russell 1000 growth, right? Growth has been the dominant theme. And what's really interesting to me is that even extended to small caps. Now, small caps have been underperformers for the better part of 2 years, but we're actually starting to see something where small cap growth is actually outperforming the S&P 500. If we take a look at IWO, the Russell 2000 growth ETF, so small cap growth, it is outperforming relative to SPY. So that's a kind of a new dynamic as we get going into the second half of the year, where the growth theme is extending down to small caps. Now, I mean, I've disliked small caps for a long time. It's been mostly a relative trade, and relative strength work has gotten me to favor large over small, much as it's gotten me to favor growth over value. But now I'm starting to pay a lot of attention to the growth theme within small caps. So that's a little bit of a change in trend and a change in our view as it relates to equities. Another change as it relates to equities is also centered on growth, but this time we're leaving the United States. Now, for a long time, I've thought it best to favor the US against the rest of the world. But now with growth really taking over in equities, you can even see it. If you look at an ETF like the MSCI EFA Growth ETF, ticker symbol EFG. So these are an ETF that holds stocks from Europe, Australia, and the Far East. That's actually starting to outperform relative to SPY or the S&P 500 as well. So I think from an equity standpoint, it makes sense to continue to favor the growth theme. However, I think it also makes sense to broaden that theme out to include small caps and to include the growth theme outside of the United States. Now, some subtle shifts also taking place in the fixed income landscape, right? So for a long time, the trend and the momentum has been with long duration treasuries, whether you're looking at 25-year plus zero coupons or long duration via a fund like EDV. What's interesting to us at Chaikin Analytics is while that momentum remains in place, our ETF power gauge rating for those long duration treasuries and even medium duration treasuries like IEF as well have shifted from very bullish and bullish to neutral. And corporates, LQD for instance, has seen its rating turn to bullish and very bullish of late. So some subtle shifts in the fixed income market that could have implications for investors who choose to invest using ETFs and take a diversified approach, with a mix of equity ETFs and fixed income ETFs. So some subtle changes taking place in both of those landscapes. The equity side still sticking with growth, but broadening it out. But on the fixed income side, while the momentum remains with long duration treasuries, we have to start to pay attention to these shifts in our model and the ratings. So this is something I'm going to be talking a lot about going forward. It's something I'm going to be paying very close attention to. I hope you will too. I'll keep you posted with my updated thoughts. I hope everybody's having a great Thursday.